All right, good afternoon, everybody, and welcome to GenX Power's energy storage presentation. I'm Craig Sainsbury, who helps GenX with their investor relations. Just one little bit of housekeeping. At the end of the presentation, there will be the opportunity for Q&A. Please use the Q&A facility at the bottom of the screen. Type your question into the GenX team, and I'll ask that for them. So again, just a reminder, Q&A button at the bottom of the screen, type your question, and I will ask that to the presenters. So with that, today we've got Simon Kidston, who's Non-Executive Director, James Harding, CEO, and Craig Francis, CFO from GenX, to talk you through their energy storage strategy. And with that, James, I'll hand over to you.
Thanks very much, Craig, and I'm delighted to welcome everybody to our energy storage presentation today. I'm very glad to be speaking to you from our Kidston Pumped Hydro construction site at the moment. That's why I'm wearing this colourful shirt. But I can tell you construction is in full swing up here, and tell you a bit more about that shortly. But this is all about storage, and in particular battery storage, this presentation. As you know, GenX is a diverse renewable energy provider with both a portfolio of both renewable energy projects and energy storage. By 2025, our portfolio will provide clean energy to over 350,000 homes and offset 2 million tonnes per annum of CO2 emissions. The diverse portfolio includes 2 operating solar farms, one up at Kidston at our Clean Energy Hub in North Queensland, where I am currently, and one at Gemelong in New South Wales. We have 2 projects in construction, the Kidston Pumped Hydro Storage, our flagship project, and the Baldercombe Battery project, which we'll talk about in this presentation. And we have a near-term development project, the 200 megawatt Kidston Wind project. So this is all about the energy market being in transition. As you'll know, we are moving increasingly quickly from the traditional baseload market, traditionally fed by fossil fuel coal-fired power stations, to a renewable energy future. There's increasing demands for energy, and that is nowadays all being filled by intermittent renewable energy projects. This chart shows that increase in renewables, both wind and solar, and the black line you can see is the corresponding exit of coal-fired power plants. You can see by 2050, it's almost all gone from the network, and increasingly we're seeing that curve steepening as more and more announcements of earlier closure of coal-fired power are coming on. So we see the need for more and more renewables and increasingly huge quantities of large-scale storage to balance. So GenX Power, we believe, is ideally placed to meet this market requirement. We see what renewable energy generation does is provides lots of clean power whenever the wind is blowing and the sun is shining. But that often leads to oversupply at times where the customers don't need it, and undersupply where there's high consumer demand, for example, in the evening peak. So volatile pricing, it affects the system stability. And there is a requirement for a balance to be brought into the system, and that's where energy storage comes in. It stores energy for dispatch at times where it's needed. It balances out the pricing and provides a quick release of power when it's required. And GenX is well placed to meet this need with its portfolio of wind and solar projects and its current energy storage strategy, which enables us to hedge our revenue and to provide additional value to our shareholders. So this slide just shows the current landscape of large-scale batteries on the NEM. So you'll see there's a handful largely across the southern states, South Australia and Victoria, that have been in operation for the past few years, starting in 2017 with the big battery at Hornsdale. And then you can see in Queensland, it's largely a blank sheet. There is one project that's being commissioned currently. And then that triangle shows the Baldercombe Battery project, which is our recently announced first large-scale battery storage project in central Queensland. This slide talks to the real exponential increase in requirement for large-scale storage. Over 120 gigawatt hours of capacity will be needed by 2040. That's about between 40 and 60 gigawatts of storage, depending on the extent of capacity. the two charts, you can see the current operating on the NEM on the left-hand side, and the right-hand side is in gigawatt hours. So it's 1,000 times the scale of the left-hand slide. So if you put the current operating battery plants onto the right-hand scale, it wouldn't even feature. So I'll just hand over to Craig Francis to talk through the Boldington Battery project in some detail.
Thanks, James. So yeah, this shows the Boldington Battery project. It's our first standalone battery energy storage system as part of our sort of battery strategy, which we're looking to develop over the coming years. It's 50 megawatts for 2 hours, so 100 megawatt hours, and it's located in central Queensland. It's actually, the way we've located the battery is for the cheapest connection cost possible. So it's located on Powerlink land next to an existing Powerlink substation, and has a really short connection run of underground cables into that existing substation. We've contracted with Tesla, and I'll talk to that on the next slide, for supply of their Megapack 2.0 battery modules, and construction has now commenced, with financial close occurring on the 28th of February, which we announced on the 1st of March. So this is really exciting. It's fully funded following our capital raising, and construction is underway for first generation in 2023. So the Megapack technology is essentially assembled in Nevada. It's an existing technology, the most widely seen in the NEM, and it's assembled at their Gigafactory in Nevada and shipped, ready to be installed at site in yeah, so it's a single unit and shipped. There's 40 of them, and they'll be shipped directly to port and trucked to site and installed simply on concrete plinths to be established there over the course of this year. Sorry, James, next slide, thanks. So this is what really excites us about the project, is the structure we've put in place with Tesla as the off-taker, and really is an innovative structure that allows us to capture the upside from the energy storage economics. So just to take you through the financials, the CapEx of the project is $59 million, that's confirmed now, and we're forecasting average revenue of $11 to $15 million out to 2030. So that's sort of shown on the chart on the left-hand side. That range is set by essentially a banking case, $11 million being system normal, no heat waves, no power plant outages, no major failures. And $15 million is our more realistic case, where we see contingency events featuring in the market, and these happen all the time. I'll talk to those in a little bit more detail on the next slide. The way the offtake structure works with Tesla is essentially it's a guaranteed minimum level of revenue, and then we share in the upside above that. So a really innovative way for us to secure contracted revenue for project finance and get the real upside from these contingency events, which flow straight through to equity. The operating life of the...
Sorry, I was just going to say, if I can just jump in and make one comment. Had this plant been operating last year, revenues from the plant would have exceeded $20 million. So whilst I guess we presented the banker's base case of $11 million and an equity case of 15, had it been operating earlier, it would have substantially exceeded that. So I think that's an important point in terms of financials, the ability to bring a step change to our revenues from mid next year. Sorry, you can.
Absolutely, Simon. And that revenue flows through to EBITDA in line with the rest of the portfolio. The EBITDA margins are greater than 75%. So we're going to see lots of cash coming off this project, and really driven by those, that increasing need for storage, the economics that drives in terms of arbitrage and revenues from providing network support services. What we're showing here as well is an IRR range of 9 to 17%. That 9 is really the bottom end, a very conservative sort of lender scenario, but we're really going to see where we think sort of mid-teen plus IRRs from this project, which is why we're really excited about it. This next slide just, sorry, do we have maybe we don't have that other slide. Maybe just go back to the previous slide then, James, sorry. Look, just in terms of these events that we're referring to and Simon alluded to last year, We do see that these contingency events occur in the NEM. There was an event last year, an explosion at the Callide power station, which triggered huge fluctuations in energy prices, allowed the project, had it been operational, to capture $5 million over the space of a month. So that's essentially a third of the annual revenues in 1 month, and really driving that outperformance, which we can now capture through this offtake structure. You might recall with our pump storage hydro project, we have a fixed price contract with Energy Australia, which underpins a significant amount of debt. However, this structure we feel is really advantageous to shareholders, because these drivers of these big price spikes and big contingency events is going to flow straight through to equity. So just on this slide, just taking you through this is a slide we've had in our deck for a while, but this shows now that Bouldercombe is committed, coming online in FY24 and contributing to those revenues. With the addition of Bouldercombe, our average revenue to 2055 has increased toward $90 million, remains highly contracted, but Bouldercombe adds a really nice piece of merchant exposure, we think, to the portfolio, giving us that upside, which we're expecting to see once it becomes operational in 2023. And the EBITDA margins continue to remain solid across the portfolio. And I guess the other thing to point out here is that we have long-term hedged interest rates with all our facilities, and that's now sub 3% with the addition of Bouldercombe, all fully hedged for the term of those facilities.
Thank you, Craig. So I'd like to just talk to some of the other projects in our portfolio, and starting off with the Kidston Pumped Hydro project. I'm up here at Kidston, as I said. This is our flagship project. Just to recall, it's a 250 megawatt, 2000 megawatt hour or 8-hour storage project. It'll be the first pumped hydro built in Australia in 40 years, the first developed by the private sector. And it'll be the third largest storage device in Australia when it's built in end of 2024. You'll recall that we're using all the existing infrastructure to the benefit of the project. The 2 existing mining voids will become the upper and lower reservoir. Flew in this morning on the FIFO charter flight onto the existing landing strip, and we have the accommodation that was used for the mine has now been fully repurposed and reconditioned for use as the construction labour camp, creating a lot of jobs, as a result of which we have really strong support, financing support in terms of concessional and grant funding from both federal and state governments. And most importantly, we have a full wrap lump sum EPC contract in place to deliver this project with absolute tier 1 contractors. And I've got a slide, the next slide will show a bit of detail. So yes, as you can see at the top here, McConnell Dowell and John Holland are acting in joint venture as the EPC contractor. These are 2 of the leading construction companies in the country, will be well recognized to everybody, but they also have the most apposite skills in terms of underground tunneling, dam construction, and structural, mechanical, electrical work. So complex civil projects is what they do. We have a full lump sum fixed price contract. So that was kicked off in May last year. All the pricing for deliveries, supplies, labor, materials are locked in. So there is no risk of any escalation on the project. Andritz from Austria is providing the specialist pumped hydro equipment. Again, that is part of a fixed price contract, which is a nominated subcontract within the overall EPC contract group, so part of the full wrap. The photos you can see here show principally the main access tunnel portal. You can see the stabilization works have been complete on the face of that portal, and we kicked off underground construction in that access tunnel in January ahead of schedule. And the schematic diagram there shows that access tunnel, the purple looping tunnel going down into the grey powerhouse cavern at the bottom. That's 1.5 kilometers long. That'll be constructed through the course of this year. And then the powerhouse cavern will be built. And the 2 intake and twin tail race tunnels. The intake shafts are those vertical white shafts into the cavern, and the yellow tail race tunnels go out into the lower reservoir. You can see the timeline across the bottom. We kicked off in May last year. We've completed all the preparation, what we call stage 1 works, all the site establishment. I'm speaking from the joint venture offices here at site, with laydown areas and aggregate works complete. You can see that excavation underground has started, and this year we will see the detailed design works being completed. The Wises Dam, which is the upper reservoir, will be fully constructed, and we will see also, we are seeing the kickoff of the manufacture of the turbine and generator equipment by Andritz. And so we are fully on track, on budget, progressing really well towards completion and start of operation by the end of 2024. So our two existing cash producing renewable energy projects, two solar farms, the Kidston 50 megawatt solar farm, being just alongside me here, has been operating since 2017. That is has always been a very strong performing solar farm. It's among the top 4 best performing solar projects on the NEM. And we enjoy a very strong 20-year offtake agreement with the Queensland government, which gives us very secure cash generation. Our newest project, the Gemelong 50 megawatt solar farm just outside Forbes in New South Wales, that's been in operation since June last year, operating really well, very strong technical performance. And because it's selling into the spot market, we are seeing very, very good revenues indeed, very good pricing, almost $84 per megawatt hour average during the last quarter. So we're on track between those two cash producing assets to generate north of $20 million this financial year. And so just to complete our near-term pipeline project, the Kidston Wind 200 megawatt project development, we've identified a good wind resource to the south of the Kidston mine, which we've been developing for the past 18 months or so, in collaboration with our strategic partner, J-Power, who have earned in 50% of the project and are funding the development through to financial close. We're going to use the existing infrastructure that's being built for the Kidston Hydro project, namely the new transmission line that PowerLink is building for us with co-funding by Queensland government, and the spare capacity will be used to transport that wind power into the NEM. So we're really ramping up activities this year and aim to deliver financial close mid next year, 2023, and start operations in early 2025.
So I guess just by way of summary, I think what I'd like to demonstrate is that we have now delivered a portfolio with embedded growth. And if we look at the two operating solar farms, we'll have revenues this financial year in excess of $20 million. As Craig mentioned, that's being produced on very high gross margins. We expect that revenue to step change materially by mid next year when we see a contribution from the Bulldocken project. So we've got embedded growth from our portfolio as it is right there. Of course, as James has explained, our pump hydro project, our flagship project, remains very much on track. We've got a fixed price contract with the leading builders in the country, and that project will be commissioned and generate first revenue by mid-2024. Of course, the wind project, which we're developing 50-50 with J-Power, will be making a contribution the following year, calendar year, FY25. So we've got a very strong portfolio. Much of those revenues are locked in under long-term contracts. And I think as the portfolio has matured, we'll be in a position to consider paying a portion of those cash flows to shareholders as dividends once these assets are fully operational. Just a quick word on, I guess, our the way we like to operate, where the business has a very strong focus on communities, people, and the environment. In terms of people in the community, we've got a very strong Indigenous engagement program. We've also got a very strong program that encourages females to participate in meaningful roles in the construction sector. And I believe we've hit all of our KPIs in terms of engagement on those two factors. So something we're very, very proud about. James did mention the environmental contribution in the form of CO2 abatement. Some 2 million tonnes per annum saved by the contribution of this portfolio is significant on a national scale and makes a meaningful contribution to the decarbonisation of the Australian economy. Just in terms of the company being a listed company, I think it's worth noting that we as GenX are now one of the few companies in the renewable energy space listed on the stock exchange. Whilst some 5 years ago, there was a handful of companies, we've seen those being taken out one by various major players, to the point today where there's one, maybe two companies in our space providing exposure to shareholders that wish to participate in that decarbonisation and wish to have exposure to that thematic of energy storage that we've tried to explain during the course of this presentation. So look, I guess in summary, what I'd like to say is we've got a diverse portfolio. It's more than $1 billion of capital invested into the renewable energy space. We've done so with some very strong partners, both the federal government, the state government, and some leading industry players and financiers. That portfolio provides a very high level of revenue certainty. The majority of that revenue is contracted for up to 30 years. That revenue will produce a very solid EBITDA margin, which over time we hope and expect to pay out a portion to shareholders. So in summary, 400 megawatts of committed projects. We've got a pipeline which is exciting, which will drive further growth. And I believe we've got a board and management team that can execute this strategy to deliver GenX as a leader in the Australian renewable energy market. So just a final point to leave is the fact that we've now got a share purchase plan. This has been conducted following the institutional placement we completed earlier this month, which was put in place to fund the construction costs of the Bordeaux battery project. The offer for the share purchase plan is open now. It closes next Thursday, the 17th of March. And the pricing of these new shares will be the lower of 15 cents, which is the placement price, or the volume weighted average price of the shares as they trade next week on the ASX. So with that final comment, I guess we'll open up to any questions.
Thanks, Simon, Craig and James. Just a reminder, use the Q&A facility at the bottom of the screen to type your question in and I'll ask away. First questions come in around the opportunities for other battery projects through Queensland and potentially through the eastern seaboard of Australia. Can you just update the market on any further plans around that battery storage strategy, please?
Yes, I'll take that. Thanks, Craig. So we certainly do have plans for further batteries. We see the Bouldercombe battery as the first in our battery strategy. It's sized, as you know, at 50 megawatts for 2 hours of storage. And that enabled us to deliver it in reasonably short order and with a relatively simple structure. We believe that there's scope for a number of further larger battery investments on the NEM. We're particularly keen on Queensland. I think we've indicated that we feel we know the Queensland market particularly well, and we see the very strong case for arbitrage in Queensland. So the difference between charging cost and generation price, and that really underpins the value along with the other revenue streams that are known, FCAS and system strength services. So we believe that there will be opportunities for GenX to develop at least probably one or two larger batteries in Queensland, and we are also looking closely at New South Wales as a possible site for what we consider will be our pipeline of battery projects.
Thanks. That leads nicely into the next question is, have you considered attaching a battery to the Gemelong solar plant?
Yes, we have. That's obviously a possibility for us. There are some complications regarding the position on the network, and there is indeed the grid connection issues that arise with retrofitting, either increasing capacity or putting a battery behind the meter do bring complications regarding grid connection and generator performance standards, which need to be negotiated with AEMO. So we are looking at that. We have considered it and we continue to look at it, but we believe that there is a good case that we've established for standalone batteries, and that is the sort of more immediate path that we're pursuing.
Thanks. Question on the expected lifetime of the battery and what's its expected performance over the duration of life?
So do you want to take that, Craig?
Yeah, I can take that. So the battery at Bouldercombe is warranted for 20 years, and that's a warranted degradation profile, which, if we fall below, Tesla will come and fix it and restore it to that level of performance. We expect the battery will have a life that it extends beyond 20 years. And what we're showing in those IRRs is just that warranted 20-year period. So there's definitely upside from the battery to what is sort of shown in that base case. I guess at year 20, we can continue to operate the battery for another 10 years with further degradation of the cells. And degradation means that instead of charging 100 megawatt hours and you can only store, say, 70 megawatt hours sort of thing. We can continue operating on that basis, or we have the option of replacing the cells and restoring it to its initial condition and going again. So a lot of options available to us, but certainly the life will extend, in our view, beyond 20 years.
Thanks. Obviously a strong relationship with Tesla at Balticum. Had you explored other battery technologies, and is that relationship with Tesla something that you can replicate through other potential battery projects?
Yeah, so I think the answer is yes and yes. We certainly went out to market initially and received some quotations from a number of the leading suppliers. There are some good battery providers out there. We selected Tesla on the basis of obviously their commercial offer, their technology, and their I guess their reputation and their knowledge of the market. They were the first to establish a large-scale battery in Australia, the Hornsdale Big Battery. They've learnt, so their auto bidder algorithmic bidding system, which is their proprietary bidding system, has been in operation since that time and has made a lot of money for the owners of that project. And a combination of those factors led us to choose Tesla, and we have that unique offtake arrangement with Tesla whereby they'll run the battery basically as merchant, and we will share the upside. So going forward, absolutely, we have developed, we think, a good relationship with Tesla. We are certainly keen to look at further opportunities together, but I'd say we're also not bound. We are technology agnostic, and we do value having diversity within our portfolio. So we will be looking to do more with Tesla, but also be in discussions with alternate suppliers.
Thanks, James. There's quite a few questions that have come in around different battery technologies. I'm just going to group all of these together for people that have asked the questions. Are you able to give a little bit more, if you can, update on the technological comparison between, I think this is zinc bromide flow batteries, ZN-BR, and also the CATL batteries versus Tesla?
James, do you want me to maybe
Sure.
field that one? I guess the way we've approached our portfolio development is using established technologies, and the reason for that is it enables us to access cheap project finance. So obviously that's reflected in the solar projects that we finance today, and pump storage hydro is a very well established technology. And when looking at batteries, again, we went to the more established technologies being, I believe it's sodium phosphate cells, I think, lithium phosphate cells is the basis for the batteries we're installing at Balticum. We will continue to look at alternatives, but again, we don't want to be the first movers into new technologies, because we think that represents quite a bit of operational risk and technology risk, and that's not the game that we're in. We're in using established technologies, accessing project finance, and really having innovative financing structures to deliver what we believe is attractive returns for our shareholders.
Thanks, Craig. Maybe another question for you here, Craig. The percentage of battery revenues that will be contracted and what are subject to merchant prices and fluctuation with that Tesla relationship. And then just there's another follow-on question from that one is, as more batteries enter the market, do you think merchant prices will hold up and still provide the returns that you're getting at the moment?
Thanks, Craig. Yeah, look, with the arrangement with Tesla, it is subject to confidentiality. We can't give precise details on that offtake agreement. What we can say is it's an 8-year term for which they're guaranteeing a minimum level of revenue, and that will change over the term, and the percentage that's shared with them above that minimum level will also change over that 8-year term. For the balance of the 20-year warranted period, the battery will be operated by us, and we just pay them a fixed fee for using their auto bidder software. So we can't really give much comment on the split between what's the proportion guarantee and the portion that's merchant, only to say that a significant proportion is merchant and flowing through to us in the form of upside sharing. The second part of that, in terms of the funding mix, is that where you went, Craig, with that one?
So I think The second question is obviously that more batteries will come into the market over the next.
Sure, yeah, sure.
The dynamics.
Sorry, I'm looking at some of the questions on my screen, which I shouldn't be doing. Yeah, so I guess the reason we've selected Queensland is, the batteries currently in the NEM, a lot of them have made their revenues from the frequency control and ancillary services market. So that's network services typically, and that's really what we've seen in South Australia with the Hornsdale first big battery in the national electricity market. The reason we've selected Queensland is while it does have access to those markets, it's really underpinned by a solid arbitrage business case, buying in trough periods and charging the battery in trough periods and discharging in evening peak periods. And we've learned a lot about that from our work on the Kidston Pump Storage Hydro project, where we really see a prominent price shape in Queensland with prices going close to zero and sometimes negative in the middle of the day, optimum time for charging, and really peaking in the evenings, and that becoming more and more pronounced with more and more rooftop solar in particular coming into the network. So I think the future for FCAS is still strong. The FCAS will grow and continue to grow as renewable penetration increases, and we're going to see that as we move to 80% renewables in the next decade. However, really the basis for this project in particular being in Queensland is underpinned by that solid arbitrage business case. So we think the revenues are going to continue to stay strong and throughout the forecast period, although there's varying views about FCAS in the market.
If I can just add just one concluding comment to that, Craig, I guess this slide in many ways is the most significant slide in the presentation. And what it really shows is the terminal decline of coal-fired power. So just do not underestimate the impact of this line. We see every now and then Origin, AGL, Energy Australia, the major owners of coal-fired stations, announcing the closure of these massive plants. These plants are 1,500, 2,000 megawatts. So the impact of these closures is gigantic, and it will be gigantic over the next 10 years. Of course, that capacity will be replaced by wind and solar, which is fine if the wind's blowing and the sun is shining when customers and consumers need the energy. So this structural shift here is fundamentally going to underwrite the revenue for any energy storage business. So whether it's pump hydro, whether it's batteries, the profit opportunity is immense. And I firmly believe in many ways the numbers we presented here underestimate or conservatively present the opportunity in front of our shareholders.
Look, I agree with that, and maybe I could just add something else to that. That decline, what it brings not only is the need for more renewables, and they need to be matched by storage, and supports that arbitrage case, but also existing FCAS revenues we think will stay strong, but also new value sources will arise. And the more that coal-fired power, the baseload power exits the system, the more the value of having stabilizing generation and sources of energy on the network is realized and needs to be captured. And we'll see that there's talk of capacity payments, which might be brought in. There's talk of fast frequency response, which we think will be a factor in the next 2 or 3 years, and other value streams we think will emerge. And batteries are ideally suited because they can always be adapted, upgraded, software firmware upgrades to match these new revenue streams as they come on. So very, very strong underpinning of value.
Yeah.
Thanks, James. Maybe another just question for Craig. 9 to 17% IRR. Is that something that we'd be expecting as a minimum hurdle for other projects that GenX may look at? And if you can, what is the assumed debt financing in that 9 to 17%?
So the debt financing, we did announce a couple of weeks ago that we have locked in the debt financing now, a $35 million facility from a group called Infradebt, who've come up with quite an innovative arrangement for us, and a 12-year debt facility, which is really good gearing, we think, for this structure, which has this element of merchant exposure. So the 9 to 17 is based on a $24 million equity investment. It's a post-tax equity IRR and really driven by that revenue range. Now, as we said, the 11 million we think is very conservative. It doesn't factor in real life events, which we know do occur, and they will continue to occur, and likely with increasing frequency. So, we still see a double-digit hurdle rate as an investment requirement for us as we go forward and develop new projects.
Great, thanks. Just changing tact a little bit here. There's a few questions that are coming in around Kidston Hydro. Are there any incentives for the EPC team to bring the project on early? And flip side to that is, if there is any delays, are there penalties under the RAP term contract?
Yeah, so they are, well, they're certainly incentivized to finish as early as possible. They actually have a target date, an internal target date, which is ahead of the schedule that I showed on that slide. And they are certainly bound by liquidated damages to the extent that there are delays that are attributable to them. So I'm very pleased to say that they're performing well within that target timeline. And those liquidated damages that would be payable were they to be delayed fully cover us against any provisions under the offtake arrangement. So they're absolutely matched in terms of covering our liabilities. So we're very happy with the progress so far, the team that the joint venture has on site, and the collaboration that is there between GenX, the JV, and others on site.
Yep. Again, on Kidston, you mentioned before fixed price contracts, so no risk there from the inflationary pressures, but any concerns around supply chain issues in getting some of the larger CapEx items to site?
So the principal, the biggest items, I guess, the largest from a supply chain point of view being shipped in from offshore are the Andritz scope equipment. I'm pleased to say that Andritz has an extremely good track record, and they manage all the supply chain basically by and large within their own facilities. So they will source most of the key equipment from their works in Austria, the generators from their own 100% owned factory in India, and the large fabricated components for the turbines in China, all from within Andritz 100% owned facilities. And we've been very close to Andritz during the course of the contract, and we're pleased to report that there's been no delays during COVID so far, and no expectation of those to come. Thanks.
Health and safety, obviously a major focus. Question there, can you provide any update to health and safety, in particular LTIFRs, if there have been any through the construction phase so far?
Yeah, so again, McConnell, John Holland, two of the leading complex civil construction contractors in the business. They have excellent OH&S processes, which are matched very closely with GenX's own processes. Obviously, GenX is the owner of the mine and the site. And so we have implemented WHS procedures for the overall location, which we own, and we've matched those requirements and processes with the EPC contractor's own. So it's been extremely safe. There've been virtually no environmental incidents of note, and virtually no lost time incidents either. I don't have the exact figure, but it's extremely small.
Yeah, just changing tack a little bit here. Given that it's an old gold mine, is there any valuable material that's been extracted from the tunnel and powerhouse construction phase?
Well, I mean, there's valuable material in terms of the aggregate that we can use for other construction activities. In terms of gold being found, look, I think Barrick and its predecessors had, 13, 14 years to dig two big holes in the ground. And I think they probably haven't fully exhausted it, but I think the grade will be sufficiently small that that's not going to feature.
And staying with pumped hydro, obviously an Australian leader on this, the first project in the last 30 years to be built. Are there other pumped hydro projects that you're looking at through Australia? And a specific question here, is there the opportunity to use any form of coal mining voids for pumped hydro?
Yeah, good questions. Yes, we are. We obviously want to be very selective. It's not a simple process to embark on pumped hydro developments. They're large investments and they're complex projects. But we do see real value, which we've captured for the market, and we see that's just going to increase as the storage case that we've outlined in this presentation reveals. So we'd like to apply the very real learnings and experience that we've made at Kidston to other opportunities, and we are looking at selected other opportunities on the NEM. in terms of coal mines, we think that's problematic. So one of the real benefits of Kidston, it's probably some of the best rock structure, and we're talking about tight rock structure, which doesn't allow permeation of water. It's got strong integrity, and that's almost unique from what our tunnelling colleagues tell us in the country. I think coal mines, obviously by definition, just do not have that level of tightness. So we do think that there's potential for other mining type locations, but probably there won't be coal mines.
Thank you. Moving away just to more broader strategy, are there any plans for additional smaller solar or wind power stations, farms, etc., to be built? In particular, solar, given that we've seen New Energy Solar exit their Australian market.
So yeah, we certainly have plans to develop more renewable projects. We see solar, especially in Queensland, where we're most active, is a bit problematic because of the prevalence of it. There's so much solar, particularly rooftop, that we find that pricing during the day, when obviously the sun is shining, is reduced. That's why we're so happy with our very strong 20-year fixed offtake arrangement with Queensland Government on our One Kidston solar project. So we do have an eye on solar, but that's probably more for the medium term, and as we see the market evolve. Wind, on the other hand, we do see as having a particular attraction. The profile of wind generation, and we've seen that at Kidston, is extremely good. It matches demand very well. So we'll certainly be looking for other opportunities for wind in the shorter term. Excellent.
Moving just into a few financial questions that have popped up. One around Bouldercombe you're developing now. You've brought on some more debt and raising capital. Was there any consideration given to delaying the project until Kidston was cash flow positive and self-funding that from internal cash?
Yeah, look, I guess we really saw the opportunity with Bouldercombe as one of being a first mover in Queensland. We had to move now to lock in the Tesla price and the order, our place in the queue for the mega packs to be manufactured and delivered to site. I think delaying to 2024 would be a missed opportunity, really, in our view. We see lots of opportunity over the coming years as a first mover to really capture those revenues from those contingency events. As Simon said, this battery would have made $20 million last year had it been operational, and we don't want to see any more of those years go past us without having an operational battery that allows us to capture the merchant upsides that we see in Queensland going forward. So that's really been the driver for bringing the Bouldercombe battery on. I guess, we did, and I think this has sort of been a concern generally that we've heard, is that dilution to fund the equity component of the project is the outcome that we've sort of got here, and do we consider other options? I guess we were looking at bringing partners in for Bouldercombe. What we found was it was probably too small to share at a $60 million fundraising with a $24 million equity component. However, when we are looking at future battery developments, we are looking to scale them up for that very reason, is we want to take a model of co-development and partnering early on with really credible and groups with really strong balance sheets to really minimise any need to come back to shareholders to fund those, and really rely on our partners to bring them to market and into the portfolio. So that's going to be our strategy going forward. But for Bouldercombe, we just really saw this opportunity to move quickly, decisively, and we should be positioned to be generating really strong revenues in FY24 or calendar 23.
Yeah, I think we've got a really good critical mass now of earnings and embedded growth from our existing portfolio. And as Craig mentioned, the way we look at our pipeline with the Kidston wind farm as a case in point, we'll develop those with very strong partners who will be able to carry GenX to some extent in terms of delivering these projects. So we'll provide the experience, the smarts, the on-the-ground skills and capability, and we'll look for partners that can assist us with the funding of these very significant pipeline projects, whether they're wind farms or big battery projects.
Great, thank you. Again, on capital and equity, very strong revenue from 2025 onwards, very strong EBITDA margins that are plus that 75 to 80% level. should be very cash flow positive business. Have you given any consideration to where that capital will be deployed and potential longer term dividend policy?
Look, I'll take that. I think as a shareholder, I'm very keen for as much of this cash flow to be paid to shareholders as possible. Realistically, that won't be happening in the next couple of years. I think the most important thing is to make sure we commission all of our projects. We do so on time and on budget. But clearly, the sort of revenues we're talking about here, there's a potential for dividends to be paid out over time. So I don't think we'll commit today as to what year that will be, but certainly free cash flow after debt service and the payment of that to dividends will be a high priority.
Thanks, Simon. Just a question on guidance. Will we be seeing any form of profit guidance for this year or next year?
We have provided guidance by virtue of this slide. In my view, there's very few companies that give guidance to 2055. We do so, and we do so with confidence because of the contracted nature of our revenues. So in terms of this financial year, FY22, we're guiding in excess of $20 million from our 2 solar farms. The first half came in at just over $10 million. So we're certainly on track to hit that full year profit guidance or revenue guidance, I should say.
Great, thank you. Just one technical one, so maybe one for James to pick up. What would the impact of battery and electric vehicles be on the load, storage, discharge of the NEM? Any major upgrades required?
Yeah, so obviously electric vehicles very, very interesting and potentially could really add to the ability, well, add to demand initially on those times of day issues, especially around solar. So I think we may see distributed storage in the form of electric vehicles across the NEM over time, and that may increase quite dramatically once electric vehicles really start to pick up in the sort of medium term. But I think what that is, it sort of replicates, and what we're going to see on the network overall is just this move, not just from fossil fuels to renewables, but from centralized to a mix of central and distributed generation and consumption. So, and I just think that batteries, whether they're residential batteries on the home or whether they're electric vehicles, sort of replicating that behavior, will sort of add that additional sort of piece of the jigsaw puzzle of lots of strategically located central renewables and large scale storage and distributed, so small scale rooftop solar and distributed storage to balance.
Fair to say that all of our forecasts do look at scenarios which and there's a base case for electric vehicle impacts on demand and distributed storage and sort of all-in-one home power plants, and that is all factored into our forecasts and those revenues that you see. So I don't think we're looking at any sort of shocks here from a faster rollout of EVs. The assumptions are all pretty aggressive. What we are seeing is an overall increase in demand throughout the NEM from wholesale markets, and we're going to be positioned to profit from that.
Right, thank you. Look, we're coming towards the end of time, coming towards the end of questions. There's sort of two more that I'll bracket together here in the Q&A. It's around the share price. A fair few questions have come in on that. Last time you raised capital, it was around the 20-cent mark. Clearly markets have been weak globally. Recently, GenX share price now is down around that 15 cents. Can you please just give an update, if you can, as to why you think the share price is where it is today?
Look, I think in the short term, Craig, I guess we'd attribute it to the macro issues that we're seeing playing out in Europe. I think what we're seeking to demonstrate by this presentation and others is that the portfolio now has genuine scale, it's diversified, and we've got embedded growth. The risks associated with the construction have been managed through the placement of fixed price contracts. So the projects are performing well, the plants are performing well, and I believe over time, our share price will re-rate to, I guess, around consensus guidance where the brokers talk about fair valuation, which is a substantially higher number than our current share price. That may not happen overnight, but I certainly think with the tailwinds we're seeing in the industry, the decarbonisation, the strength of our portfolio, our share price will re-rate closer to those valuations.
Great, thanks. And Simon, probably the last one for you, and it's probably a question you can't answer, but a few people have asked it, so I'll ask it on their behalf. You have mentioned the strategic nature of GenX. There's been a lot of consolidation in the sector over the past 5 years. Not many companies left that you can play, the renewable energy theme from. What are your expectations for GenX as an individual standalone company going forward, and have you had any approaches from any potential inquirers in the past? Now, I know you can't answer some of those, but I just wanted to put those questions forward.
Yeah, look, our strategy is firmly focused on the execution of our pipeline and ensuring our projects get developed, as I've described, on time and within budget. I think we'll keep our focus on that. And if there's approaches, they'll be assessed as they come, but we're certainly not seeking corporate approaches with the share price down here at 15 cents. I think that would be a grave mistake given the hard work that we put in and the value of this portfolio. So we'll see how things play out, but meantime, the management team is very focused on delivering value through the execution of our renewable strategy.
Thanks, Simon. Look, that's it for questions. Thanks, everybody, for joining. Simon, I might hand back to you for just a reiteration there of the SPP timeframe and any closing remarks.
Yeah, thanks, Craig. So just in summary, the share purchase plan has been mailed to shareholders. It closes next Thursday, the 17th of March, and the pricing is the lower of 15 cents or the volume average weighted price. So we genuinely hope we're seeing a low in the share price today. If that plays out, I guess we'll see this is a very good way to get additional exposure to the company. So thank you very much for your interest.
Thank you.
Thanks very much.